Hello everyone, my name is Mark Newman. I get a lot of questions from people at the moment who are looking at buying an asset, for example a motor vehicle, and they want to find out, if I finance the equipment, do I claim a tax deduction when I receive the item and it's ready for use, or alternatively, do I claim the tax deduction as I pay it off over a number of years? And I want to take you through that process of when we actually claim it in this video. Now, the first assumption I'm going to make is that the asset that we buy, the business is able to claim as a tax deduction in full in the year that they purchase it. So assuming that the asset meets those requirements, how does the finance of the equipment, for example a vehicle, affect it? So what we need to consider is what are the processes and the steps that are involved in this. The first one is the purchase. So let's say we want to buy a vehicle. We walk into the dealership and we actually select the vehicle that we want. After a bit of negotiation, we actually sign the contract saying that I want to buy this vehicle for $50,000. The dealer's then going to ask us a very important question, and that is number two, how are we actually going to pay for that? Now there's two options I'm going to use in this video. One is we've got the funds in our own bank account and we just transfer it to them and it's paid in full. Alternatively, we actually finance it. And that is, we pay it off over a number of years. So for argument's sake, a vehicle of $50,000, our payments may be $1,000 a month or $12,000 per annum. So how does paying off the vehicle affect its tax deductibility? Well, it doesn't. We have two separate transactions. The first transaction is what triggers the tax deduction. The ATO states that when the vehicle or equipment is installed and ready for use, that is, we can claim it as a tax deduction. So that for people who are looking at rushing out buying a vehicle prior to 30th of June, we actually have to have the vehicle registered in our name to claim it as a tax deduction prior to 30th of June. That is, it's ready for us to use. So once we have the vehicle, the asset, in our names, that's what we can actually use to claim it as a tax deduction. So therefore, when we receive it, we'll be able to claim that $50,000 as a tax deduction. So what does that mean in the second year? Well, after we've claimed the $50,000, for tax purposes, it now has $0 value. So we're not going to be able to claim the vehicle costs itself. We'll be able to claim the running costs, for example, petrol, registration, repairs, insurance, etc. But what about the finance payments? A lot of people ask me, what happens with the finance payments? Can we now claim them as a tax deduction? Well, partially. For finance, there's actually two parts. Part of this finance payment will be actually the reduction of the debt that we owe to the bank or the financier, and part will be interest. We can actually claim the interest as a tax deduction. Now, is this going to be the $12,000? No. A lot of deals I'm seeing come through at the moment for a $50,000 vehicle, they're getting 4% finance. Now, 4% finance is going to lead to about $1,000 of interest in the first year. So of the $12,000 in the first year, only about $1,000 is going to be tax deductible. Now, as the value of the loan reduces, obviously the amount of interest that's going to claim is going to reduce as well over time. So that's a very simple explanation. The finance, the way we pay for an equipment or a vehicle, for argument's sake, doesn't affect the tax deductibility, providing the asset meets the tax deduction rules. If you have any questions about buying assets, equipment, and whether it does meet the rules and also its financing, please do not hesitate to reach out and contact me. Thanks for listening. Mark Newman.